Hello friends, this is Victor here. Welcome back to the Intelligent Investor channel. In today's video, as requested by many Patreon members, I'm going to analyze Meta stock. Specifically, I'm going to explain why I believe Meta stock will eventually reach over 3 trillion in market cap over the next several years. At the time of making this video, Meta's market cap is very close to 2 trillion. If you have been following my YouTube channel for a while, you may remember that I started making videos about Meta or Facebook stock back in early 2021. I was very bullish on Meta stock back then. In fact, I even predicted that Meta would reach over 1 trillion in market cap in my early videos. But I did make one mistake along the way. During the bear market in 2022 and early 2023, I made the mistake of selling Meta stock and took a loss because I thought that Meta was a value trap. Almost all the major tech stocks were oversold and were down at least 30% from their recent peaks, mainly because of macro headwinds such as high inflation, high interest rates, and broader market correction. The market was extremely fearful back then. As for Meta, Apple introduced the App Track Transparency Framework that started requiring users to give permissions before apps such as Facebook and Instagram can track users' activities across other apps and websites. Of course, most people do not want Meta to track their activities across different apps and websites, so Meta's advertising value was greatly impacted. Meta predicted that Apple's ad tracking option will reduce Meta's revenue by $10 billion a year. As a result, I made the mistake of selling Meta when it was deeply oversold and undervalued. Now, to correct my mistake, I bought back more Meta shares afterward. Fast forward to today, Meta's revenue and profits have rebounded significantly over the past 2 years. Thanks to Meta's large investment in AI, Meta's advertising business is no longer heavily impacted by Apple's ad tracking change. In the most recent quarter, both Meta's revenue and earnings came in above analyst estimates, and the company's guidance for the next quarter is also well ahead of analyst estimates. This is why Meta stock has soared a lot in recent weeks, and its current market cap is very close to 2 trillion. Of course, when it comes to investing, it's about looking ahead. So in today's video, I'm going to talk about Meta's long-term growth prospects. I will explain why I believe its market cap will eventually grow over 3 trillion in the next several years. First, I will give you a quick stock portfolio update. Then I will discuss Meta's biggest risks and headwinds to consider, Meta's long-term growth prospects, Meta stock valuation, and whether I will buy more Meta shares going forward. If you like this video, make sure to hit the like button, subscribe, and turn on the notification button. I will continue to make many excellent stock analysis videos every week that will help you become a great investor. Each video usually takes me more than 30 hours to make, so if you like this channel and want to support it, check out my Patreon blog in the video description. Our goal is to help our members become multimillionaires through investing. Once you become a premium member, you can follow all the stocks I'm investing for the long term, follow my personal stock portfolios, and download the latest intrinsic wealth models for the stocks I'm analyzing, so you know when a company becomes undervalued, fairly valued, or overvalued now. Also, you will have access to all my latest stock ratings for the stocks I'm analyzing. The link is in the video description. Take a look, let's start. Before we dive into Meta's biggest risk and headwinds, let me give you a quick stock portfolio update. The S&P 500 has soared a lot in recent weeks, and there are several reasons. First, Trump has not been escalating his reciprocal tariffs as aggressively as before. The market has learned the taco trade, which stands for Trump always chickens out. Second, most S&P 500 companies have reported much better earnings than expected in recent weeks. As long as this trend continues, the S&P 500 will continue reaching all-time highs over the long run. Third, the market is expecting that the Fed will likely start cutting rates starting in September. This will benefit US stocks the most because the cost of borrowing will be lower for many companies, which will help them grow faster and earn higher profits. However, we also need to look at the market's overall valuation. If you look at this ratio, that compares the FINRA margin debt to the total US dollars in circulation, it's now above 0.4. Historically, this suggests that the market is slightly overvalued and that many investors are taking too much margin to buy stocks. Also, if you check our S&P 500 valuation chart here, we can see that the market is overvalued, even though it's not at the extreme greed level yet. Typically, I'd be more concerned if the market is extremely greedy, while the thin-wall margin debt ratio is well above zero point 0.4. This means that the market will likely have a correction in the upcoming months. Here's what I'm doing right now in case the market is overheating and correcting soon. I'm planning to hold more cash so I can buy the dip if the market corrects later on. Recently, I started trimming some of my non-core holdings. For example, I sold Amazon in my mom's trading account and the gain was around 40%. I also sold most of my ASML shares in one of my accounts and the realized gain was around 27%. My main investing strategy is to keep concentrating on my top core holdings, which are the best companies that I understand the most. I like to keep investing in the best companies whenever their shares are undervalued. Then instead of trading them, I like to hold them for the long term so they can become large multi-bagger stocks in the long run. For example, in this first account, my top core holdings are MasterCard, Microsoft, Visa, Amazon, TSMC, Meta, Google, and NVDA. I just hold them for the long term, even if there's a market correction, because I know that their businesses will grow much more in the long run. I bought back Meta shares when its market cap was still under 1 trillion. This is the second account. My investing strategy is the same. I just keep holding these top core holdings, such as TSMC, Visa, Google, NVIDIA, Microsoft, and Meta, because I expect that their businesses will grow much more in the long run. This account used to be larger, but I had to sell some stocks to pay down my mortgage last year and earlier this year. This is my third account. Since it's much newer than the two other accounts, it will take slightly longer for these outstanding businesses to become multi-bagger stocks. In this account, my top core holdings are NVIDIA, Meta, TSMC, Broadcom, Amazon, Microsoft, AMD, and Apple. My non-core holdings include Spotify, Costco, Mercado Libre, SML, ServiceNow, and FICO. Right now, based on my latest intrinsic value calculations that I share with all my Patreon members, I believe SML, ServiceNow, and FICO are greatly undervalued, so I'm holding them longer until they start making gains. If the market continues to rally, I will likely trim some of my non-core holdings, lock in the gains, and keep more cash on hand. Then, if there's a correction in the upcoming months, I will be ready to buy the dip again. Let's go back to Meta. What are the biggest risks and short-term headwinds we should consider? I believe there are two major short-term headwinds that will likely impact Meta's margins and free cash flow over the next several quarters. First, Meta is expected to increase its capex more this year and much more next year. Most of these large capex will be going toward AI infrastructure or AI data centers. At the same time, Meta is planning to spend hundreds of millions or even billions to hire the best AI talent in order to build Meta's super intelligence labs. Second, Meta's Reality Labs or its metaverse business is still losing billions every quarter. Meta's metaverse business is still a very niche market. It won't be profitable anytime soon. As I mentioned earlier, Meta reported outstanding earnings in the most recent quarter. For example, Meta's revenue grew 22% year over year. Its operating income increased 38% year over year. Its EPS also grew 38% year over year. Its operating margin expanded to 43%, up from 38% in the same quarter of last year. On top of that, Meta's daily active users reached 3.48 billion, which was a 6% increase year over year. Ad impressions rose 11%, while the average price per ad increased 9% year over year. These growth rates are outstanding, especially considering that Meta already has a massive revenue base, nearly 3.5 billion daily active users, and is heavily investing in AI infrastructure and AI talent. Management gave this guidance recently. This guidance shows that Meta's biggest headwind will be much higher capex and higher operating expenses that will likely impact Meta's margins and free cash flow over the next several quarters. Management said this: we expect third quarter 2025 total revenue to be in the range of 47.5 to 50.5 billion. While we are not providing an outlook for fourth quarter revenue, we would expect our year-over-year growth rate in the fourth quarter of 2025 to be slower than the third quarter as we lap a period of stronger growth in the fourth quarter of 2024. We expect full year 2025 total expenses to be in the range of 114 to 118 billion, narrow from our prior outlook of 113 to 118 billion, and reflecting a growth rate of 20 to 24% year over year. While we're still very early in the planning for next year, there are a few factors we expect will provide meaningful upward pressure on our 2026 total expense growth rate. The largest single driver of growth will be infrastructure cost, driven by a sharp acceleration in depreciation expense growth and high operating costs as we continue to scale up our infrastructure fleet. Aside from infrastructure, we expect the second largest driver of growth to be employee compensation as we add technical talent in priority areas and recognize a full year of compensation expenses for employees hired throughout 2025. We expect these factors will result in a 2026 year-over-year expense growth rate that is above the 2025 expense growth rate. We currently expect 2025 capital expenditures, including principal payments on finance leases, to be in the range of 66 to 76 billion, narrow from our prior outlook of 64 to 72 billion and up approximately 30 billion year over year at the midpoint. While the infrastructure planning process remains highly dynamic, we currently expect another year of similarly significant capital expenditures dollar growth in 2026 as we continue aggressively pursuing opportunities to bring additional capacity online to meet the needs of our artificial intelligence efforts and business operations. According to this guidance, Meta's capex is expected to reach around 69 billion at midpoint, but by next year, Meta expects that its capex will likely grow by another 30 billion. This means Meta's capex will likely reach nearly 100 billion in 2026. Of course, this higher expected AI infrastructure spending will benefit NVIDIA the most going forward. You may be wondering, why is Meta spending so much money on AI infrastructure to build its AI super intelligence labs? The answer is very simple. Meta doesn't want to be left behind in the current AI race among US big techs. Mark Zuckerberg's new vision is to bring personal super intelligence to everyone. This is a huge change from his earlier vision in building the metaverse. Based on what I know, over the past few years, Meta has been losing many top AI researchers to OpenAI, Google DeepMind, Perplexity AI, and other AI labs. More importantly, Meta's recent frontier AI models are significantly behind the latest models from OpenAI, Google, and XAI in almost every category. For example, according to the Artificial Intelligence Analysis Index, the top 10 LLMs today are mostly dominated by OpenAI, XAI, Google, Anthropic, Alibaba, and even DeepSeek. Meta's latest Llama 4 model doesn't even make the top 10 list. This is why Zuckerberg is spending hundreds of millions or even billions to hire the best AI researchers from OpenAI, Apple, Google DeepMind, Anthropic, and other AI labs. As I mentioned earlier, Meta expects its capex to reach around 69 billion at the midpoint of this year. Looking ahead, Meta expects that its capex should increase by another 30 billion next year. This brings Meta's total capex to around 100 billion by next year. Of course, this will have the biggest impact on Meta's free cash flow starting next year. According to Meta, its Prometheus AI cluster is scheduled to come online next year. This is expected to be the world's first gigawatt-plus AI cluster. After that, Meta is planning to build the Hyperion AI cluster, which will scale up to 5 gigawatts over several years. Meta has consistently grown its advertising revenue and operating income while also expanding its operating margin in recent quarters. Looking ahead, we should expect that Meta's operating margin and free cash flow will likely decrease temporarily over the next several quarters. This is because Meta is spending a lot of money on AI talent and AI data centers. Moreover, advertising still accounts for about 98% of Meta's total revenue and 100% of the company's operating income every quarter. Meta's Reality Labs business has been losing billions of dollars every quarter since the start. This trend will continue for at least several more years because Mark Zuckerberg is betting on the next computing platform, which will likely be AR glasses. Zuckerberg has made it clear that he doesn't want Meta to be dependent on Apple and Google's ecosystems. His vision is to build AR glasses with AI to replace the iPhone and Android phones. Given that Meta's capex will be higher this year and much higher next year, its free cash flow will likely decrease temporarily by 2026. If we look at Meta's recent balance sheet, we can see that its cash and short-term investments have decreased significantly compared to last year. At the end of last year, Meta held about 78 billion in cash and short-term investments. But in the most recent quarter, Meta's cash fell to around 47 billion, while its total debt increased slightly to nearly 50 billion. Meta still maintains a very strong balance sheet, but this sharp decrease in cash suggests that the company is likely overspending on AI infrastructure and build-outs. Meta reportedly invested 14 billion in Scale AI just to bring Alexander Wang and his team over to Meta Super Intelligence Labs. Let's talk about Meta's long-term growth prospects and its biggest growth catalyst going forward. I will explain why I believe Meta will eventually reach over 3 trillion in market cap over the next several years. First, according to this consensus forecast here, Meta's revenue is expected to grow by around 19% this year. After that, Meta's revenue is expected to grow in the mid-teens each year over the next several years. Meta's EPS is expected to increase by around 18% this year. Next year, Meta's EPS growth is expected to have a huge dip. I believe this is mainly because Meta is spending billions on AI data centers now and hundreds of millions to hire AI researchers. This will likely impact Meta's earnings growth by next year. However, Meta's EPS is still expected to grow in the mid-teens in most years over the long term. As long as Meta's revenue and EPS continue to grow above 10% each year over the longer term, Meta's market cap will eventually reach over 3 trillion. Second, if we compare Meta's recent TTM net income to Apple's, you will see that Meta only needs to grow its earnings by about 39% to match Apple's 99 billion in net income. Achieving 39% earnings growth over the next 5 years is very realistic and achievable for Meta. Meta already dominates and has the largest economic moat in the social media market. It has nearly 3.5 billion daily active users that continue to grow and is the second largest advertising platform in the world, just behind Google. Mark Zuckerberg is making a massive bet on Meta AI and frontier AI models because he believes that artificial general intelligence or AGI will have the biggest impact on society and many businesses going forward. His vision is to bring personal super intelligence to billions of people. Of course, if he succeeds, Meta will be worth much more in the long run. That's why Meta is spending billions of dollars on AI infrastructure every quarter and hundreds of millions more to recruit top AI researchers. But the biggest downside is that these AI investments will likely not generate significant revenue directly anytime soon. Over the next 5 years, the main growth driver will still be Meta's social media platforms, which include Facebook, Instagram, Messenger, WhatsApp, and Threads. Over the next 5 years, I believe Meta's advertising revenue will continue to grow steadily over time because of several reasons. First, advertisers will continue to shift their ad spending from offline to online advertising. Second, advertisers like to invest in platforms that have the most users. Meta has the largest daily active users compared to other social media platforms. Third, advertisers like to invest in platforms that have the highest return on ad spending. Based on what I know, Google Ads and Meta's advertising platform have the highest return on ad spending compared to other advertising platforms. Fourth, Meta will continue to release new features and AI tools that will improve user content, user engagement, and of course, ad performance. And fifth, one of Meta's biggest competitive advantages is its network effects. Billions of people use Facebook, Instagram, WhatsApp, or Messenger every day. Typically, once you're used to these apps, it's very difficult to leave them because most of your friends, family, and colleagues also use them. At the time of making this video, Meta has close to 3.5 billion daily active users. This number will continue to grow gradually over time because Meta is constantly rolling out new features such as Reels and AI tools that can improve user content and user engagement. For example, based on my experience using Instagram, I noticed that Reels or short form videos have improved much more in recent years. The AI generated videos are much more engaging and interesting than before. Other than growing the user base, Meta will continue to increase the average revenue per user over time. There are two main ways for Meta to grow its average revenue per user. First, Meta continues to improve its recommendation engine, allowing it to show ads that are more relevant to each user. One of Meta's biggest competitive advantage is that it has a lot of data on each user. Meta knows what every user likes and dislikes based on their past behaviors. This is why Meta can often deliver more relevant ads to each user without impacting the user experience. And second, Meta's average price per ad has been increasing almost every quarter. This trend will continue for many years because advertisers are always looking for the best social media platforms that can help them find their target customers and that have the highest return on ad spending. As I mentioned earlier, Meta has the most user base that will continue to grow steadily over time because of Meta's network effects. Moreover, Meta's advertising platform has one of the highest returns on ad spending. This is why advertisers are willing to pay higher prices to advertise on Meta. Many investors don't realize this. While Meta does not make money directly from Meta AI, at least not yet, its core advertising business has improved significantly over the years because of its massive investments in AI infrastructure and AI tools. This trend will continue for many years. Here's why. Meta has poured billions into AI infrastructure, advanced AI tools, and AI power recommendation systems. These systems help advertisers reach their target customers more effectively, increase conversion rates, and improve their ad campaigns. At the same time, Meta's AI investments have greatly improved content recommendations across Facebook, Instagram, and other apps. Now, by showing users more engaging and relevant content, people spend more time on Meta's platforms. And of course, higher engagement means more ad impressions, stronger demand from advertisers, higher average ad prices, and ultimately higher advertising revenue for Meta. This flywheel effect is very hard to copy. Now, I want to show you the most important parts of Meta's recent earnings call. Mark Zuckerberg talked about his new vision for the company, explaining why Meta is investing billions in AI infrastructure and spending hundreds of millions to recruit top AI talents.
Our business continues to perform very well, which enables us to invest heavily in our AI efforts. Over the last few months, we've begun to see glimpses of our AI systems improving themselves. And the improvement is slow for now, but undeniable. And developing superintelligence, which we define as AI that surpasses human intelligence in every way, we think is now in sight. Meta's vision is to bring personal superintelligence to everyone so that people can direct it towards what they value in their own lives. And we believe that this has the potential to begin an exciting new era of individual empowerment. A lot has been written about all the economic and scientific advances that superintelligence can bring, and I'm extremely optimistic about this. But I think that if history is a guide, then an even more important role will be how superintelligence empowers people to be more creative, develop culture and communities, connect with each other, and lead more fulfilling lives. To build this future, we've established Meta Superintelligence Labs, which includes our foundations, product, and fair teams, as well as a new lab that is focused on developing the next generation of our models. We're making good progress towards Llama 4.1 and 4.2, and in parallel, we are also working on our next generation of models that will push the frontier in the next year or so. We're building an elite, talent-dense team. Alexander Wang is leading the overall team. Nat Friedman is leading our AI products and applied research. And Shengjia Zhao is chief scientist for the new effort. I spent a lot of time building this team this quarter. And the reason that so many people are excited to join is because Meta has all of the ingredients that are required to build leading models and deliver them to billions of people. The people who are joining us are going to have access to unparalleled compute as we build out several multi-gigawatt clusters. Our Prometheus cluster is coming online next year, and we think it's going to be the world's first gigawatt plus cluster. We're also building out Hyperion, which will be able to scale up to 5 gigawatts over several years, and we have multiple more Titan clusters in development as well. We are making all these investments because we have conviction that superintelligence is going to improve every aspect of what we do. From a business perspective, I mentioned last quarter that there are 5 basic opportunities that we are pursuing. Improved advertising, more engaging experiences, business messaging, meta AI, and AI devices. And I continue to think that glasses are basically going to be the ideal form factor for AI, because you can let an AI see what you see throughout the day, hear what you hear, talk to you. Once you get a display in there, whether it's the kind of wide holographic field of view like we showed with Orion, or just a smaller display that might be good for displaying some information, then that's also going to unlock a lot of value where you can just interact with an AI system throughout the day in this multimodal way. It can see the content around you. It can generate a UI for you, show you information and be helpful. I mean, I personally think that, just like, if, I wear contact lenses, I feel like if I didn't have my vision corrected, I'd be sort of at a cognitive disadvantage going through the world. And I think in the future, if you don't have glasses that have AI or some way to interact with AI, I think you're kind of similarly probably be at a, pretty significant cognitive disadvantage compared to other people who you're working with or competing against.
Let's talk about Meta stock valuation. There are many ways to value Meta stock. The simplest way to value Meta stock is to look at Meta's forward Ps and its expected growth rates over the next 2 years. This year, Meta's forward PE is projected to reach around 28. I think this is reasonable given that Meta's EPS is expected to grow by around 16 to 18% this year. Next year, Meta's forward PE is expected to decrease slightly to around 26. I believe this is a bit high, considering that Meta's earnings growth will likely be very low next year. Of course, the main reason is that Meta's massive investments in AI infrastructure will likely impact its earnings and free cash flow by next year. I want to show you this fair valuation tool. It helps you find out whether a stock is likely undervalued, fairly valued, or overvalued now. This tool works very well for most stocks in the S&P 500 and Nasdaq 100. I actually used this valuation tool to buy more Meta shares during the large dip about 4 months ago when Trump started his trade war. We plan to release this investing app within the next 3 months. On this chart, the orange line represents Meta's fair value over time. The blue line shows its share price, and the dotted lines indicate price targets. Meta stock has surged in recent weeks after reporting earnings and guidance that beat analyst expectations. As of now, Meta is trading very close to its fair value, which we estimate around $770 per share. For comparison, the average analyst price target is around $850 per share, while our own forecast is more conservative at around $703 per share. So based on the fair value trend shown by the orange line, Meta should be fairly valued. Personally, I will wait for a bigger dip below its fair value before buying more Meta shares. I also calculated Meta's intrinsic value using this intrinsic value model. If you want this intrinsic value model, you can download it from my Patreon blog. The link is in the video description. These are the key assumptions in this calculator. First, I define Meta's intrinsic value as its future free cash flows discounted to the present day. I used a discount rate of 10.5% here. Based on the biggest risk and the long-term growth prospects I talked about earlier, I believe Meta's revenue will grow between 12.5% and 17.5% this year. After that, I believe Meta's revenue will grow at a compound annual growth rate or CAGR between 10% and 15% each year over the next several years. My base case scenario is that Meta's revenue will continue growing at around 12.5% annually over the next several years. This is much more conservative than the consensus revenue forecast I showed you earlier. I used a long-term growth rate of 7% to calculate the terminal value. If you want to be more conservative, you can use a lower long-term growth rate to calculate the terminal value. Next year, I believe Meta's free cash flow will have a larger dip because of its large investment in AI infrastructure. However, over the longer term, I believe Meta's free cash flow margin will still expand gradually over time. Let's go over these three case scenarios: worst case, normal case, and best case scenarios. Under the worst case scenario, we forecast that Meta's revenue will grow by around 12.5% this year. After that, we believe that Meta's revenue will grow at a CAGR of 10% each year over the next several years. Then Meta's interest value should be around 1.78 trillion for the entire company, or $692 per share. I'm giving this scenario a 25% probability here. Under the base case scenario, we forecast that Meta's revenue will grow by around 15% this year. After that, we believe that Meta's revenue will grow at a CAGR of 12.5% each year over the next several years. Then Meta's interest value should be 1.98 trillion for the entire company, or $669 per share. I'm giving this scenario a 50% probability here. Under the best case scenario, we forecast that Meta's revenue will grow by around 17.5% this year. After that, we believe Meta's revenue will grow at a CAGR of 15% each year over the next several years. Then Meta's interest value should be around 2.2 trillion for the entire company, or $854 per share. I'm giving this scenario a 25% probability here. If we add all these numbers here, Meta's interest value should be around $771 per share. I also use the forward sales valuation model to estimate Meta's interest value, which should be around 1.7 trillion for the entire company, or around $673 per share. If we calculate the average of both valuation models, I believe Meta's interest value should be around $722 per share. Morningstar has given Meta a much higher fair value, around $850 per share. After considering all the valuation methods I showed you earlier, I believe Meta is either fairly valued or slightly overvalued now. So will I buy Meta stock? The answer is yes. I plan to keep adding more shares whenever the stock dips below its interest value. In fact, I bought more during the large drop about 4 months ago when Trump started his trade war. Looking ahead, Meta's earnings growth will likely be very low next year, mainly because the company is investing billions in AI infrastructure. These investments will likely impact Meta's earnings and free cash flow over the next several quarters. That said, I believe Meta's core advertising business will continue to perform very well over the next 5 years because of its massive network effects, growing daily active users, AI-powered app platform, and content recommendation system. Advertisers will continue increasing their spending on Meta because it has the largest user base, over 3.48 billion daily active users, and because Meta has one of the highest returns on ad spend in the industry. At the time of making this video, Meta will only need to grow its net income by around 39% to match Apple's net income. This is why I believe Meta's market cap will eventually surpass 3 trillion over the next several years. Now, all these are only my opinions and my analysis that's based on my research. They are not financial wise. There are always risks associated with investing. It's very important to invest in what you know and not speculate. You will need to do your own research and do your extra due diligence first before investing anything. Thank you for watching this video and supporting our channel. This is Victor from the Intelligent Investor channel, and I will see you in the next video.